Good afternoon, all of you. A very warm welcome once again to you, gentlemen. And I think if I can borrow a line from the previous presentation, the time is now when you talk of balancing growth and profitability and the new imperatives. If I can start with you, Mr. Reddy, first, that what you think are the key factors currently that a CFO has to keep in mind when kind of walking this tightrope.
Thank you, Sumana, and thanks to Financial Express for giving this opportunity to address this gathering. See, I think I will start with a kind of small difference of opinion, okay? So to me, I think balancing growth and profitability for any CFO or for any company for that matter is not really a new imperative, okay? It has always been there, okay? So some companies see this have see this at the earlier stage of the evolution, and some companies tend to see this at a later point of time. And today there is a lot more amount of talk and discussion around this because the new age companies, which tend to have a lot of burning out of cash of investors, are really being forced by the active investors or the private equity or venture capitalists to really generate profits so that they start to get the returns. So probably that they set some kind of context. But otherwise, for some of the companies where I have worked for, or maybe the bunch worked for, so like Castrol, I guess that, this has always been the imperative, right? So the factors I would say in terms of what could help the CFO in terms of being able to balance the growth and profitability, I would really say that, when we talk about growth, it's all about future, right? So it's all about future. It's all about market share, gaining the customers and gaining the new revenue streams, so on and so forth, so that we are getting ready for the future, right? And to give better valuations and value creations for the customers, and that requires a lot of investments, and that requires a different set of I would say the cultural behaviors on the part of the company. And to me, I think it all starts with mindset. You cannot have a company grow, okay, if you don't have the people who have that mindset, right? Starting with the leadership team, at least to the execution level, So that I would say that is a very, very important factor there. And when as we go through this path of growth, right, so how do we make sure that we have a clarity with respect to what path we want to choose or how we want to grow, right? And there I think that in my view, it's extremely important for any company to have a clear strategy, because that sets the tone for the company, that sets the boundaries for the company, and it also gives a kind of sense of how people should trade, as they embark on this important journey. There are a lot of ifs and buts which come on the way, but I think the most important thing I would really say is that execution of that strategy, right? We may talk about have a fantastic strategy in place to grow, but it is the execution what makes the difference to the company. And for CFOs, I think, this going on through this journey becomes easier when you really have the set of people who have the right mindset, a good corporate strategy, and a good framework around the enterprise risk management. Because as you tread through these uncertain times and then, in the growth path, the risks are unknown, so there are a lot of times where you are taking these decisions, which might result into some good decisions or bad decisions. But I think on the way you have to make sure that you have got a robust, risk management process so that you really don't fall into something which is a big trap over there. And above all this, I would say that a sense of collaboration among all the teams is extremely important. And I would say that if you have some of these things, probably trading through this particular balancing path is going to be, if not an easy ride, it's going to be a okay ride there.
Yeah, Deepesh, I would like you to.
I just want to build a few things. I mean, great points made by my colleague here. And I'll just pick up few things and drill down a bit on. So when we talk about growth, what is growth is a big question. In my experience, various stakeholders have different definitions of growth and expectations of growth. Somebody will say market share, somebody will say top line, somebody will actually drill down and say we need to generate cash, somebody will say acquisition of customers. So when you're working in a complex stakeholder environment where you can have promoters, you have listed company, you have minority shareholders, I think it's good to be on the same page on what growth is. Otherwise, that discussion turns out into an outcome which actually somebody is not satisfied with. So I would say that is one part of the nuance. The second bit I would just like to build is, as he rightly said, when you clear what is your growth, you will have to have a strategy. One thing about strategy I have learned in my experiences, strategy is also about closing doors. It's not always about saying, I will do this, and I will do this. By the way, it is also about saying, I will not do this, and being absolutely clear that this is not my area. Therefore, being focused and prioritizing the strategy, which can then help execution, is very important. Otherwise, there is always this confusion. And third thing I would just like to mention about is in terms of the risks. Because when you're balancing growth with profitability, you got to make sure that there is an eye on the risk, and what is the culture of risk is very important. And that you would know when you have to be able to smell that risk culture in the organization. Very, very critical. There are organizations who are willing to take a lot of risk at the expense of profitability. So you get something, you may not get something, and that trade-off is very important. And as CFOs, we need to be very proactive. And how can you convert risk into opportunities? And I'll just give an example from our industry. It's not necessarily Castrol. It's about the lubricant industry, which is, when electric vehicles came in, there was a lot of excitement. Oh, there is electric vehicles. But the transition is so long. And we got almost investor activism saying there is a risk to the organization because you deliver lubricants and electric vehicles don't have lubricants usage. So what are you going to do about it? And I think then it's about the organization to say, okay, how are you going to convert this risk into opportunity? So you bring innovation out. We came up with electric vehicles fluids, and we came up with a strategy of future-proofing our business by getting into newer areas like auto care products, going into servicing. So I think, growth, profitability, great balancing act. You don't always get it right, but very important to just keep an eye and make sure that you're keeping an eye on the delivery the stakeholders want. And that definition is very important.
That's a very relevant point, and you bring me on to my next question. What you correctly pointed out, that, it's not important just to say yes, but also say no where it needs to be. Yogesh, if you could elaborate on that, balancing the risk and innovation, and yet making it all look good on the balance sheet. How would you do that?
Yeah, sorry. So I come from a financial service industry, and so I went to managing the risk, balancing the growth and profitability. It's quite of paramount importance, in the sense we have seen entities who have lost it all. The risk has taken the entire AUM wiped off of some of the companies, and we have in the history we have seen that happening. Eroding the entire net worth of the company. So that is quite. So when it comes to managing risk or for an entity, we have traditionally been using some of the practices, but now, last I would say rather 5 to 7 years, we have seen a lot of entities have gone ahead in the data analytical tool and various there are various software, and analytical capabilities which many entities have built, and so in the sector, many we have also built a capability to have a data analytics, which ensure that how we manage the risk. When we say manage the risk, we should know where are we doing well in certain geographies, or are we not doing well, and how we uh, and we should have the ability to take decisions around the data, because a lot of time we have a lot of data, but that data, how to use that is not everyone do that properly. So we have that mechanism, inbuilt mechanism, uh, which is managed obviously at in our entity. It's managed at a CFO's office, where we have to clearly balance the risk. We have to take the tough calls, and we are able to use that data appropriately as of now.
Your reference to the use of data brings, now with there's a continuous rise in digitizing products, digitizing processes. So from a CFO's perspective, if I can start with you, Mr. Reddy, that how it helps, or what are the things that you want in terms of digitizing processes, and that helping efficiencies?
That's really a very important question. So we keep hearing these three terminologies so often that it has, and one more terminology got added of late. So digitalization, digital transformation, and now we are talking about AI, right? So all these things in some or the other way affect the products and services and the processes. My view here would be that one has to be very specific as to what problem they are trying to address for the company. Just for the sake of digitization of something, or digitalization of something, or putting AI into something, you cannot really be investing monies into that. You have to really be able to solve a business problem. How I can give you a few examples as to how I have been part of some of those experiences where this journey of digitization has significantly helped the organizations I worked for. So maybe 2-3 examples to talk about. So I used to work for this big US multinational company having operations in 40-50 countries across the world. And sheer nature of the business required huge amount of capital investments. And what that means is that you're not in a position to replicate the capacities everywhere in the world, but the products get sold everywhere in the world. So in that kind of context, getting the data information and making a sense out of it, sometimes getting the data in itself is so difficult from various countries, so you can't take any meaningful decisions. But that's when we came out with analytics platform. Okay, so and this analytic platform really gave the visibility to the management with respect to what product gets manufactured where, and how much is the capacities, and so on and so forth. And we were really able to model our entire the procurement strategy around to say how do we use this particular data of where it is getting manufactured, and then how much time it is going to take to reach the customers. And we were really able to deliver almost 200 basis points worth of profitability improvement. So that's like huge amount of dollars when you look at it at a global level, right? So what I'm trying to say here is that be very specific as to what kind of problem you're trying to solve out of this entire aspect. I can even talk about something very, very core to us, right? So as recently as a year back or so, so one of our previous panelists also was talking about the GST issues, right? So you always come across this pain of GST notices being issued for various things, either because there is lack of data or there is some, lack of clarity of understanding, right? So we implemented this DGTDS, a tool which was brought forth by EY, okay, where we were able to do the automatic reconciliations, and then we were able to send out the notices to the customers, vendors, whoever has not filed in their own returns, and thereby eliminating a plethora of repetitive works, or doing the reconciliation work, which really saved a lot of time And also not only that, it actually improved our own profitability because, so we were having scenarios like 40 to 50 lakh rupees in a year going, getting reversed in terms of the GST, credits what we have taken because we don't have the vendors or suppliers really not putting into those scenarios. So basically, I think that, the strategy I would probably recommend or approach is basically to see that, let's look at what value it is bringing onto the table and then, put in place accordingly.
Yogesh,
To
you want?
add one, if I talk about from the financial service industry, digitization or IT spend is a survival for them. I mean, they don't have to think whether I need to do that or I need to this. If they don't spend adequate money on, there are many processes like from customer acquisition to credit underwriting to the operations and to the final disbursement. All processes, if they are not digitized or if they have not put adequate technology, they will not be able to compete and they will get. And in fact, in financial services, I have seen entities have at least 20-25% of their OPEX to 75% of OPEX spent on IT. So this is so important when it comes to an financial service sector. It's a question of survival for us.
Yeah, I just want to add a few more comments. And, firstly, so digital is a buzzword, everybody likes to speak, and, I think that's one part of the story. But I just want to give an use case around how digitization can help grow revenue. Because many times what happens is one assumes or prepares business case for digitization to reduce costs or bring efficiency. And like he said, define the problem statement very clearly. Very important. Very, very important. Digital, for heck of it, is going to waste millions of dollars. And therefore, one of the things that we had a challenge is we wanted to grow in rural, and I know both the companies you work for has a very deep rural sort of footprints, and we wanted to get rural as well. And the question was, how do we get there? The route to market was clear. We have a very good distribution strength. But how do we make sort of finance available to a entrepreneur and help the entrepreneur, get unsecured financing? That was very important. And that's where I think partnerships help. We kind of tied up with one of the sort of fintechs and, made sure that our digital systems where we do sales ordering and invoicing spoke to the fintech's digital solution, as a result of which at an invoice level we could actually give financing. And this I'm talking about right in the rural, which means for us it's the plant, then product goes to the warehouse, then from warehouse to distributor, then dealers, then workshop, and then the rural customer. So it's so far in the chain. So I think that is the key in terms of defining the problem statement. And I'll just give one more quick example. This is about, our ecosystem is the mechanics and truck drivers. We have about 500,000 mechanics. And again, the lubricant sort of box or container goes right up to the mechanics who are the advocates. Now, if we want to run a scheme for them, how do we ensure that the scheme money that we wanted to give to them as part of take actually goes into their bank account? Now, that's where the digital came in, because behind the caps, we put in a barcode, and when the barcode was scanned, it went right into the mechanic's sort of bank account straight away. Now, the thing is, from a CFO point of view, it gives me 2 or 3 things. One, I get to know, sitting in my room, the effectiveness of that spend. And we are talking about 10 rupees, 20 rupees sort of schemes. Multiple transactions happening multiple times during the day. And we're talking about something like 20, 30 million transactions, which not even startups sort of can boast of today. So that's one advantage. The other advantage is, typically the old process was 5 years ago. You will have somebody, signing a form, and then they will calculate on an Excel sheet and print it. The sales executive will sign it, then the mechanic will sign it, then it'll go to distributor who will sign it, then it'll go to the head office, somebody will review in the finance team. By the time you disburse that claim, it is almost like 3 months. So customer experience is not good. Yeah. So I just want to summarize by saying that very important customer at the heart of the entire digital sort of change that is happening. And as CFOs, we need to make sure that we don't just apply the lens of efficiency, but also the lens of revenue growth. How can you grow revenue is very important.
Fair point. And if I can take a leaf out of what you were saying, that and how we were discussing a little earlier also, that markets are very volatile now, be it commodity prices or the geopolitical dynamics or the political setup globally and its potential impact or investor activism. So what, according to you, Mr. Reddy, if I can start with you, that, in terms wearing a CFO's hat, how do you manage all of these, manage to factor in all of these uncertainties and a certain bit of reputation management also, and yet keep, the numbers clocking?
So very heavy loaded and has so many aspects in that, Sumana. So see, I think, the priorities change for the companies at different points of time, not undermining the relevance of other aspects. But I would say that in today's context for global corporations, like ours, managing the fallouts out of the geopolitical, consequences is really significant. To give examples around this, say during COVID time, right? You had the freight costs growing over the roof if you are shipping one container from India to say US. And it hits your P&L in a very, very bad manner, right? So then it goes down and then it comes back again now because of the geopolitical issues. So in all these kind of uncertainties, how do you make sure that you are protecting your profitability becomes very, very important, right? So certainly, I think one thing which the CFOs have to do is that clearly be aware of, the market insights as well as the geopolitical insights. So that will actually give you an opportunity to see how you can correlate to the impact it's going to have in your operations, and make sure that the contractual framework is designed in such a manner there. Right? In this instance, for example, you could say that hey, instead of incorporating the freight and duties and all those things into, like, say, into your own invoice, you could probably put that as a recovery. Then what happens is that whatever ups and downs can get adjusted as such. So I think you really have to be on the top of it, understanding the market insights and then the geopolitical insights to be able to manage these scenarios effectively. And of course, some of these commodities, are really, really volatile at this point of time. And I think the only solution to that is be on the top of it, and then make sure that you really drive either the revenue maximization or drive down the costs in order to be able to protect the P&L.
Yogesh, if I can ask you, like from the financial sector perspective, some use cases that you could share with us to elaborate on these points.
Same, yeah. So I mean, as such, this geopolitical risk does not have a direct impact on financial services as such, but definitely it has an indirect impact on two counts. One is definitely what we have seen, how Indian economy is also getting impacted because of the geopolitical risk what we are carrying, and in terms of the repo rate, I mean, and we have seen the rate of interest have hiked by the RBI for so long, and now they are constant. But the cost of fund remains elevated for us, and in turn it poses a risk on our net interest margin, and where our, as a CFO's duties also, how we protect our NIMs, I mean, how we see other avenues where we can make the NIMs, we protect NIMs, or that one aspect. Second aspect, so that is really challenging environment, and so sometimes we have to take a call. I mean, so as an entity, it's very difficult to take a call whether we have to go on a walk of profitability by increasing the rate of interest, or we have to protect our customer by charging them the same rate of interest where we take a, so that's a difficult choice. But many times and as we also have decided against that, because we have to see that growth should continue, not at, though we profitability may take a back seat for the moment, and we, that was one. And secondly, we have seen some stress because of the overall impact on the Indian economy, the, where the customers are under stress, and that, but however that we still try to manage by uh, saying, I mean, we have as in few analytical tools where we know which customer, which segment, which profession we should not do the funding, and so that way we have protected our what I should, we call it as a NPA percentage. So we have been able to maintain our NPA, or in fact we were able to bring it lower the NPA percentage. But at a profitability, yes, we have taken that decision, because at the end of it, to protect customer interest, and so that is what.
Deepesh, I would like to hear your viewpoint also. What Yogesh was just saying, that sometimes one has to take a look, take a dent in the profitability from the customer perspective, and you were also highlighting how customer is at the core of the whole thing. So if you could elaborate using use cases.
Yeah, no, absolutely. I think, look, I mean, we are in a oil and gas industry, and everybody knows the volatility of crude oil and the associated sort of byproducts of crude oil. But let's just step back. The geopolitical risks, geopolitical events, what can you do about it? Can you control it? No. Can you influence the outcome of that? Really not. So what you can do as an organization is really respond. And for responding, one needs to have various scenarios as part of your risk management strategy. Not everybody can predict geopolitical events, but if you have a process in place where you are able to kind of think through past experience and predictive models that these are some of the risks that will come through, then that just helps you take steps which are proactive. So you are if you can be slightly ahead of that event occurring, and I know it's difficult, but if you have various shapes and scenarios, then as a CFO, that is your core responsibility, to be giving heads up to the management and working through some of those things. And I mean, I can give an example of crude oil. There are times when crude oil goes to about 100, 150, and there are times when it also goes to 50. And obviously, as a listed company CFO, I cannot have such a big variability in my P&L delivery because there'll be profit and there will be losses. So therefore, it's very important that how do we convert this into our pricing strategy. So what we've done is we've looked at a pricing strategy which is not reactive, but more which is more looking forward and strategic. And therefore, when we take a pricing action in the market with our customers and keeping the customers at the heart of it, because some of this, remember, impacts your customers as well. It impacts consumption, given the commodity of oil, right? It impact the petrol price, etc. And if you go in with a price increase and squeeze the customer, it is going to have a sort of a double whammy. So I think that's very important. So we have this pricing models in place. And we've worked very hard. I mean, you don't get it right all the time, but more often than not, we've been able to establish through learning. So that's one thing. The other thing I just want to talk about is costs. It is important in tough times, one should also look at cost very, very minutely. Now, of course, as a CFO, we are expected to look at cost all the time. So I think, it's part of our job. But I don't know if I can give a simile. As CFOs, it's also very important that cost efficiency that we are bringing in is not just because it falls to the bottom line, but it is also about the gift the CFOs can give to the CEOs and the business, that here's my $1 million that I have saved or we have saved, and please invest in the business. So that's really where I am coming from. So, it's not about being a butcher, it's about being a surgeon, which is precisely trying to make sure that you cut the fat, but not the bones. Yeah. So I think that's really important for us as CFOs to respond in an environment where there is a lot of uncertainty. But at the end of the day, customer is the king. I know we CFOs, we're supposed to say cash is the king, but I'll build this on because, and that's the role of the CFOs now, to be business partners and strategic drivers. So customer is the king, customer is the heart of every business, and every action that we take, it has to be in line with that. So yeah, I think it's a tough act. I don't think, I'll confess, we can't get it right all the time. I mean, that's what it is. But as long as you're transparent, as long as you are able to explain, tell the story, look at that Excel sheet and say there is a judgment beyond the Excel sheet and not just the numbers in Excel sheet, that's where the skill of the CFOs come in.
That's a great point and some very interesting similes that you brought forth. We will continue with our discussion, but we have time for 2 quick questions. So anyone from the audience, if you have a question, please raise your hands. The gentleman at the back first, he raised his hand. Can we get the mic there at the end? We don't have a lot of time, so...
Decisions, a company into media and marketing audits.
Can you be just a bit louder? I don't think we're able to hear you.
Is it fine? Yeah. I'm Sandeep Khevle. I represent a company called Firm Decisions, which is into media and marketing compliance audits. Now, my question is also related to this. As a CFO, when we look at cost savings, or let's go back to this same topic, growth and profitability, media and marketing actually contributes the maximum to profitability and the growth of the organization. However, when it comes to a CFO, to deep down into media and marketing, it is always a shyness or a resistance to do that. And so why is that, and how can CFOs come over it and get into this area more deeply and figure out value from there?
Who is this addressed to? You want?
I mean, anyone can actually
I can
answer.
take it. Let me just rephrase your question if I've understood it correctly. Yeah. Question is, as CFOs, what can you do to not allow, I'm just framing in my own, not allow cut of media and advertisement expenses, which many people are shy in spending because it impacts profitability. Is that the question?
No, not really. The thing is, media and marketing expense is one of the largest investments that any organization or any brand does. However, while verifying those expenses, we only talk about cost saving and not optimizing overall, overall investment. It is looked at as an OPEX and not a CAPEX because all these expenses going into brand building. However, we don't pay as much attention as we do for maybe internal audit or anything else, but specific audits on this side are really not looked into by CFOs. And that's a very big resistance that that has been seen, experienced. And as a CFO earlier, I also did that, but I'm experiencing this quite a large.
Yeah. I'll take the question. Yeah. I mean, we spend a lot on brand and marketing. We are a consumer-focused company. Almost, I would say about 7 to 8% of our turnover goes in brand ambassadors, being on media, above the line, below the line, and all of that. And great question. But there are 2 sides of the coin always. So I wouldn't generalize it that everybody is shy. I think good companies treat this as good costs. And I would say as CFO for my organization, I definitely treat this as good cost, along with people cost and technology cost. These are good costs. And therefore we call it revenue investments. We don't call it advertisement and sales proportion because every time we are having a conversation with the business, we call it revenue investment. You're making an investment to create a revenue tomorrow. Therefore, you need to put models in place on how are you going to assess the effectiveness of that spend. Because believe me, I mean, I love marketeers, let me tell you that. But marketeers are many a times unconstrained, right? Because when you go onto TV and you go onto these spends, there is no, you have to know when to stop as well. Because how are you going to judge the effectiveness of that spend? Because affordability of a financial frame from CFO is also very important. So that's the thing. So as a CFO, I do three things. One, at the beginning of the year, I put a frame in place with my marketing head that if this is our revenue investments, then it should follow a financial frame. It can't be 10, 15, 20% of your turnover or whatever other metrics that you do, because you have to get benefit at the end of the day. Second, be very clear why are you spending. Define the objective. We spoke about that very clear. What is it? Is it an investment to maintain your brand? Is it a new product launch? Because then you have to have a burst. So the objective has to be clear and work a revenue investment evaluation after that. So that's the second part. And I think the third part really is about having open conversations. There are times where you will have to cut costs, and some of the good costs also need to be cut, because if you're going through an uncertain environment, probably among the priorities, I would say cut revenue investment first, followed by technology and then people. Yeah. So I don't know if that answers your question, but every organization is different, and brand-led organizations will definitely see the value of investing in these brands.
So, if I may add a couple of points here, at least my experience is that the marketing and brand building exercise is something which is taken as a last or maybe penultimate kind of cost item to really cut. I'm using that particular word very carefully, but certainly for optimization, so every aspect of cost needs to be looked at. And clearly, you have to really put forth as to what is the objective of this entire cost, what you are incurring. Is it something which is very specific for certain purpose, or is it just like a routine stuff? You will come across a lot of times, I want to participate in that exhibition, this exhibition. More often than not, they have no value or very little, value addition in terms of either the customer growth or in terms of brand building. So you have to be just careful, and as long as that rationally is built, I think that, most CFOs would really accommodate and then, to move forward there.
We are really running out of time, so last question that we have.
Yeah, I'm Sunil Mehta here. This is with reference to like volatility management, like when you said like you're dependent on crude as a major raw material of this thing. So just wanted to know like how do you people, by giving a practical illustration, keep the cost in check? Because as you said, $50 to $150, you do not know what exactly is the line. So what exactly is the basis where you start? Like either you start first with the forecast and then go into cost management, whatever way you do.
Yeah, sure. And we can talk offline as well, because it can be a very long answer. But we start with a 5-year view, 3-year view, 1-year view, 3-month view, and then the next week's view. This is very important, and it's a rolling sort of forecast that we do. I think it's so one is, what is the input cost going to be? And remember, for us, when we also do the crude oil projections, there is a forex element as well, because that impacts as well in terms of the depreciation. So that's your input cost. I'm overly simplifying this, yeah. That's your impact. Now, if you are clear around the margin range that you want to operate in, and I think I love the range concept, because I think people get very specific around why my margin has to be X percentage. It will not work. You need the elbow room, because especially for listed entities, there is a lot of scrutiny quarter on quarter. So we operate in a margin range, and there will be some times when margin will go slightly lower, sometimes it will go slightly higher. And that is a modeling perspective in terms of how much do you see the vagaries of it. And then what we do is, once we know that this is the forecast for the next 6-9 months, we have to do two things. One, we need to find ways of how we are going to optimize and bring efficiencies through various projects that have to keep running throughout the year in terms of the cost and formulations and supply chain activities. And the second is that you don't have a choice sometimes to take pricing in the market. And For B2B customers, of course, the pricing is more difficult compared to B2C because you are in retail and then it's more in your control. So that's the broad frame. But yeah, we can talk more offline, I think, in the interest of time.
We are into the last 1 minute.
Can I add
Yes,
one?
yes, sure.
Can I
sure.
add one? Probably to add to what he said, so you could also explore at trying to see how you can put in place, some risk mitigation, the fluctuation or volatility risk mitigation, right? Typically, it arises in two broad categories for most of the companies. Either it is the currency fluctuation or it is a commodity fluctuation. So you could go for some kind of contracts and things like that for a certain specific period of time if you are able to do, because if there is too much of volatility also, a lot of sellers might not be interested in actually getting into that kind of contracts. But obviously from the currency side, definitely you can do a lot about it, because that's very, very plain vanilla kind of, products which are there for quite a number of years. So they also help you quite a lot in terms of volatility.
Coming to the almost at the end of our conversation. So Yogesh, if I can ask your closing thoughts, especially what Deepesh was saying, that, the CFO has to be the surgeon and not the butcher, nowhere not to touch the bone. So your mantra for CFOs, how to do their work.
So last week, I was at ET conference. So one point there, Mr. L. Shiv Krishnan said that right now that CFO role has to go, he has to spend at least good quality time, maybe 20-30% time in strategy than the traditional accounting or the controllership role. So possibly, I always like to spend more time on strategizing the business growth for the entity, and yes, cost. Cost is one of the element which you should keep under control. But you should be able to see some of the cost as an investment, because sometimes when you spend on IT, you should see that it is an investment. When you, sometimes you take some of the decisions which are customer centric, so that we should have that ability to treat this as an investment for the future. Because see, at end of it, I have seen all promoters or shareholder or private equity investor, they are interested to build a valuation of the company, and that valuation of the company generally will come when everyone work on a specific strategy, and they expect that CFO to drive the strategy, not the cost element or a controllership function. So that I would always feel that we should have a strategic mindset, we should develop that, and that is where we should have more focus.
Mr. Reddy, you had also mentioned about the mindset being so important. So your closing thoughts on what makes the great CFO?
I think when we heard to the investor, and then when we heard to the promoter, two things which came out very clearly, and they are definitely very, very important. One is in terms of the transparency, the other one is in terms of the trust, and because these two things are so important. And besides that, I'll tell you, so I have come across a lot of CEOs. The primary expectation from their CFOs is great business partnership. Okay, so great business partnership, you can really create a lot of value along with your CEO. Okay, and I would really say that for being a great business partner, you should really know your business very well. So please we have to develop the great understanding of our business so that we can be a great business partner, and thereby create value for the company. And of course, the other two aspects of trust and transparency are very, very critical in my view. Yeah.
Deepesh, you were mentioning about how instead of cash, it's the customer who's the king. So what's the thought that you would want to leave our viewers with?
I think I think we as business, any business exists because you have a customer, and to add value to the customer is the first thing. Nothing else to me is more important than that. And I think as CFOs, therefore, we have to spend time to delight the customer, and everything in service of that is why we exist, organization exists. So that's very important for me, and Therefore, for the CFO and finance team and every organization, other things will fall in place. So that would be my short summary.
Thank you so much, gentlemen.